Hello and welcome to our October trade floor update. I'm joined today by Portfolio Manager Aditya Thacker. And Aditya, there's plenty to unpack from September. We saw a lot of attention on China and the property sector, and specifically Evergrande. We also saw a discussion of the inflation outlook, central bank tapering, and even debt ceilings. So how did you see it all from your seat?
Yeah, I think the increase in volatility that we're seeing across all asset classes at the moment, it's really, symptomatic of a bit of a turning point in markets. If we kind of cast our minds back over the last 12 months, there have been two very clear drivers for markets. One has been recovery from the global recession, and the second one has been the idea of reflation, sparked by higher fiscal spending in the US. And markets responded, accordingly. Equities rose, credit spreads tightened, yields rose, and yield curves steepened. But now, as markets kind of look forward to 2022, the outlook is far more uncertain. It's far more disparate and uneven. We've got to think about, where will growth settle in a post-pandemic world? Potentially more importantly, where will inflation settle, and how will central banks react to this temporary rise in inflation that we are seeing? And lastly, how will markets and economies handle when the impulse from fiscal and monetary policy turn negative in 2022? How will markets kind of react to that and economies react to that? So all of these things are building up, higher levels of uncertainty. When there's more uncertainty, there's more risk. And when there's more risk, investors require more return. And that's what we're kind of broadly seeing. We're seeing an increase in risk premia across all asset classes. And lastly, I would kind of add, as we get closer towards central bank tapering, I think it's fair to say that liquidity risk will also start to rise as well. And that's going to impact all asset classes. So, we think that this period of volatility will persist potentially into year end, at least until we get a more clear picture as to what 2022 may start to look like.
Okay, thanks, Aditya. And given what you've said about a range of possible scenarios, I think it's also worthwhile touching on performance, because in September we saw both equities and bonds decline. So how are we viewing that relationship, and specifically the correlation between those two asset classes moving forward?
Yeah, so, I spoke about, increasing uncertainty, driving, higher risk premia across all asset classes. And I think that's really the driving force behind why both bonds and equities have been declining in recent times. And we've got to keep in mind that valuations for both asset classes were also rather full as well. So there was very little buffer for risk there. But from investors' point of view, these periods of strange correlations, these periods of kind of market indigestion, they're generally pretty short-lived in the broader scheme of things. Investors, their investment horizons are much, much longer. And so they shouldn't be distracted by these short-term, movements based on daily or weekly, correlations. They really need to remain focused on longer-term measures of correlations. And we believe that they will remain, negative for bonds and stocks. When we look at the bond market more specifically, as yields rise, valuations improve, there is now more scope for bonds to rally if there was, a negative left tail scenario. Secondly, when we look forward to 2022, we believe that both growth and inflation will actually start to moderate. And that's generally an environment where bond volatility will also ease. And lastly, when we think about things on a more longer term macroeconomic perspective, we see significantly higher levels of debt around the world in response to the COVID pandemic. So we think that central banks, when they come to hike interest rates, whenever that may be, we think that the endpoint for the next hiking cycle will also remain pretty low. They're going to be quite constrained as to how much they can hike. And that's keeping neutral rates suppressed, which again should feed back to relatively lower levels of bond volatility over the long and medium term. So I think the key message here is that investors shouldn't be distracted by the short-term volatility and changes in correlation. They should remain focused on the longer-term principles of portfolio construction, with diversification being the kind of core tenet.
Great. Well, thanks, Aditya, and thanks everyone for joining us. If you do want any more information, please visit our website at pimco.com.au or speak to your local account manager. Thank you.